This is Finance Spotlight brought to you by ThinkSpace Media. Last year was a better year for stocks that many anticipated, with the market rising markedly despite rapidly rising interest rates and the potential for a recession. This year may be no less murky. So what are the best investments for this year? The list below starts with some safer picks and then moves on to those that should deliver higher returns, but may be more volatile, giving you a healthy mix of growth and safety during what looks like a difficult market environment. So look at 5 top income investments for the second half of 2024, and don't forget to subscribe, like, and share your thoughts in the comment sections. Bonds and bond ETFs. Bonds offer stable income and lower risk compared to stocks, making them a great way to diversify and reduce portfolio volatility. The bond market is bigger and more fragmented than the stock market, and because it doesn't get as much attention, many people don't fully understand it. You can buy individual bonds or go for a bond exchange traded fund, ETF, like the iShares Core US Aggregate Bond ETF or the Vanguard Total Bond Market ETF, BND. Buying individual bonds is quite different from investing in a bond ETF, says Jacqueline Shattuck, a certified financial planner and CEO of Golden Wealth Strategies in Atlanta. Your choice between individual bonds and an ETF depends on your investment strategy. Another option is an actively managed bond mutual fund. If you want more active management in your portfolio, but don't want the hassle of buying and selling bonds yourself, consider a bond mutual fund, Shattuck suggests. But if you're okay with a passive approach, meaning less active buying and selling, then a bond ETF might be right for you. When investing in bonds, it's important to consider factors like interest rates and credit quality. Right now, we find some specific types of short-term corporate paper attractive, says Stash Graham, Managing Director of Graham Capital Wealth Management in Washington, D.C. If you invest in individual bonds like we do and are patient, you can find good quality, investment-grade bonds yielding over 6%, he adds. Dividend-paying stocks and ETFs. Stocks that pay dividends are usually issued by well-established, financially stable companies. They're often less volatile than growth stocks because they provide regular income, attracting long-term investors rather than traders looking for a fast price move. In addition, these companies' stable earnings can reduce price fluctuations and offer a cushion during market downturns. Dividend-paying investments have long been utilized by retirees looking for passive income, but since Meta Platforms Inc., Meta, paid its first regular dividend in early 2024, many younger investors are now considering the impact dividend-paying investments can have on their portfolios, says Chris Rahemtala, a CFP and financial guide at New York-based Fruitful. He cites reinvestment, another benefit of dividend-paying stocks. If you do not need the income stream from dividends, you can reinvest your dividends to purchase additional shares of the company and, in turn, generate more dividends, he says. As with other investable asset classes, investors can opt for an ETF or mutual fund focused on dividend stocks. The Vanguard Dividend Appreciation ETF, VIG, is the largest dividend growth ETF, with about $78 billion in assets under management. It tracks an index of U.S. companies that have increased their dividends annually for a decade or more, and has a yield of 1.8% with a low 0.06% expense ratio. VIG's one-year return is 20.4%, matching its benchmark, and it has a 5-year annualized return of 12.9%. Long-term certificates of deposit and corporate bond funds. Long-term certificates of deposit, CDs, and corporate bond funds offer stable investment options with different advantages. CDs, issued by banks, provide higher interest rates than savings accounts and are ideal for investors expecting declining interest rates, enabling them to lock in favorable rates for extended periods. On the other hand, corporate bond funds pool investments in bonds issued by various corporations, typically with maturities of 10 years or longer. They offer higher yields than government bonds and are suitable for risk-averse investors seeking steady cash flow and higher returns while managing portfolio risk. Both investments cater to individuals prioritizing stability and predictable returns in their investment strategies. If you like topics like the top 5 investments to make in 2024 and you want more like this, let us know in the comments. Don't forget to subscribe, like, and share for more great content to help you stay healthy. Real estate investment trusts. Real estate investment trusts, REITs, are a favorite among income investors because they offer high dividend yields. The law requires REITs to distribute at least 90% of their taxable income to shareholders, providing consistent and reliable income. They also diversify a portfolio by investing in real estate, which typically moves independently from the stock market. REITs let you invest in real estate without owning property directly, says Shadek. There are different types of REITs that can diversify a portfolio beyond stocks and bonds. For instance, Graham points out opportunities in multifamily REITs. With fewer new construction projects due to lower interest and lender interest rates, supply growth in multifamily housing should be limited in the near term, he explains. If demand for high-quality rental units keeps rising, investors could benefit from higher earnings. However, Graham warns, real estate is sensitive to interest rates. If the 10-year U.S. Treasury rate rises, it could impact the entire industry negatively, as we've seen in recent years. Limited partnerships. You'll often find master limited partnerships in the energy industry. These are publicly traded vehicles that combine the tax benefits of partnerships with the liquidity of stocks and often pay shareholders a high yield. For example, one of the largest MLPs is Cheniere Energy Partners LP, CQP, which operates in the liquefied natural gas industry. You'll often find MLPs in the midstream area of the energy industry, active in pipeline transportation and energy storage. Cheniere's forward yield is 8.1%. MLPs are attractive to income investors due to their high yields, as they are required to distribute a portion of their cash to shareholders. Energy infrastructure stocks were in the doldrums from late 2019 through late 2021, but have since rebounded. We believe we are still in the midst of a multi-year rally for these once-maligned assets, says Graham. Invest with annuities. Annuities are insurance products designed to provide a steady income stream, usually for retirement. They can offer fixed or variable payments, and many people appreciate the regular income they provide without the risk of the stock market. However, annuity contracts can be complex, so it's important to understand what you're buying and whether it's necessary. In some cases, investing in stocks or bonds might be more suitable and cost-effective than an annuity. That said, the right annuity can be a good choice for someone seeking steady income. Russell Hackman, a chartered financial analyst and president of Hackman Wealth Partners in Boston, prefers lower-cost fixed annuities over variable ones in today's market. For people needing guaranteed lifetime income to replace a pension they don't have, annuities are attractive now, he says. And for those who aren't focused on income but want a safe alternative to bonds, we recommend principal guaranteed fixed indexed annuities with stock market upside of about 10% annually. This product offers protection from market downturns with a guaranteed return. Best Way Invest for the long-term investing isn't just about picking the right investments. It's about using the right strategies. A key strategy is planning to stay in for the long term, which means ignoring short-term dips and focusing on a committed long-term outlook. Regularly investing fresh capital, even when the market is down, is crucial because markets eventually recover. Diversifying your investments beyond just stocks is essential to manage risk and enhance returns. Including dividends, the S&P increased by 26.44% in 2024, showing the importance of dividends in protecting against stock market volatility. Maintain positions in fixed income investments and cash to minimize unexpected market declines' impact and provide liquidity for buying stocks at lower prices. Regular contributions to your investment accounts, such as a 401(k), traditional or Roth IRA, or a taxable account, let you benefit from growth in two directions and take advantage of dollar-cost averaging, automatically buying more shares at lower prices and fewer at higher prices. This is Finance Spotlight, brought to you by ThinkSpace Media. If you found this video insightful and are eager to learn more about achieving financial milestones, don't forget to subscribe to our channel, like this video, and share your thoughts in the comments section below. Together, let's start on a journey towards financial success.